On behalf of Crosscheck Media and Biz Talk Today TV, welcome everyone to the Money Path. I am your host, Todd Schoenberger. Joining me today is Gina Martin-Adams, the former chief investment strategist at Bloomberg Intelligence and now the chief market strategist at HB Wealth. Gina, welcome to the program. I have to start and ask you about your comments recently in the press about leadership with the MAG7 stocks. You're actually starting to see this leadership fade. Do you think maybe you could give the audience an idea of what maybe rotation out of the MAG7 stocks may look like versus, say, an outright crack in the markets?
Yeah, sure. First, thank you so much for having me again. It's good to see you again.
Yes.
Good to be in front of your viewers once again. In terms of the MAG7, it's been really interesting. Some folks might feel a bit of deja vu because we were at this point last year as well, where tech stocks were starting to fade, ceding a little bit of leadership to non-tech stocks in the index. The cyclical is starting to get a little bit of enthusiasm into the end of the year, hoping for better prospects to emerge in 2026. This is happening yet again. Now, the source of the rotation is a little bit different this time around. If you think back to where we were in October, there's a very intense correlation between tech stocks and the NASDAQ. Or sorry, the NASDAQ, obviously, and Bitcoin. And when Bitcoin started to really break down, that weighed on confidence for the NASDAQ and therefore tech stocks at large. So that's one thing that started. The second is a little bit of earnings weaknesses starting to emerge in that earnings season that was in October and early November. Most of us this week have been very focused on Oracle, obviously, as a source of weakness inside the broader tech space. That's feeding through to optimism with respect to the AI trade. But earlier in the earnings season, we had Meta. And let's not forget, Meta, as one of the big MAG7 companies, sort of missing those expectations, guiding for a little bit of change emerging in AI, has also weighed on the tech space. And then, in more positive news, the rest of the index is starting to show some growth. For the first time in a very long time, the rest of the index actually posted relatively strong earnings growth, much better than expected earnings growth in the most recent season. And the Fed ease is likely to help this group pretty materially going into 2026. One of the things that we're writing about this week is really about that Fed move this week and how it may impact tech stocks versus the rest of the index going into 2026. I think as much as we're encouraged by the fact that the Fed is reducing interest rates and the market just doesn't fight the Fed ever, one of the hidden aspects of that report this week was that the Fed upped their growth forecast for 2026 while reducing their forecast for CPI. That combination of better growth and lower inflation could help to finally light a fire under margins and productivity enhancements for the non-tech segments of the S&P 500, which could help fuel this rotation into 2026.
So are you suggesting then into 2026, because there is going to be change in leadership with the Fed, and if Kevin Hassett gets in there, you're going to have more of a aggressive rate cycle that continues through the year. So should investors be underweighting the MAG7 stocks?
I think you should be looking for opportunities outside of MAG7. It's really hard to push an underweight because they are still performing very well. Price momentum is still in their favor. They're all high momentum stocks, and momentum is frankly the only factor that's really working in the US equity market over the course of the last few years. So you want to be cautious in terms of a full-on allocation shift. But I do think you want to start to look for opportunities outside of this group to add to the mix in your equity portfolio. We've just been captivated by the MAG7 and the AI trade for the vast majority of the last 2.5 years. And you have to get to a point where you see some fundamental shifts emerge to support the rest of the groups, but it does appear that we're getting closer to that point in time. As we move from a period of time in which AI development is the only investment strategy to AI deployment being a big part of the investment strategy, you should see a transition in margin improvements from tech-specific margin growth to non-tech segments of the index. If we start to see that broader productivity enhancement, broader margin expansion emerge into 2026, it will solidify the trade. So I think we're on the precipice of this. We don't want to go full in on a non-tech sort of exposure, but we are getting closer to that going into next year.
So closer, and we may actually see different leadership as well. So let's fast forward here. Let's pretend it's the end of 2026. You and I are talking, and we are now seeing leadership broaden. We're looking for other areas that may actually rise up and maybe quietly become new leaders. Which areas of the market do you think may step up?
Yeah. Well, what we're seeing already, I think, is something that we should note as a potential sort of leadership group going into 2026 and sustaining, and that is financials and industrials. It's been in fits and starts throughout much of 2025. It's not really caught fire, if you will, but financials through the upward sloping yield curve, as well as industrials through deployment of efficiency gains, as well as pretty strong revenue growth, are already showing some signs of life. I would say I'd watch those going into 2026. And then the new entry, really just over the last month, has been healthcare. This is a sector that has really frustrated the investor base for much of the last 3 years, but did start to show some signs of improvement with the last quarterly earnings season. If healthcare can start to substantiate those earnings gains going into 2026, if we can avoid a lot of policy risk that continues to plague the sector, you could see healthcare join those groups as well. I'd say the one cyclical sector that a lot of people are talking about that I'm a bit more skeptical on is consumer discretionary. This is a group that trades far too closely with tech for us to get terribly comfortable. And if we're talking about rotation out of the AI themes, you have to talk about potentially rotation out of the two biggest players inside consumer discretionary as well, which are Amazon and Tesla. So inside discretionary, I think you could see some internal rotation. That means that discretionary as a whole sector may not be a typical sort of early cycle Fed play leader in this kind of landscape.
So what's your justification on staying away from consumer discretionary then? Is it the economy?
Yeah, it's really mostly Amazon and Tesla as those stocks that are so exposed and so intimately correlated with the AI trade, with the tech trade, with NASDAQ, even very closely correlated with the Bitcoin from a sentiment perspective. So those are stocks where they're huge inside the discretionary sector. If there's any risk emerging to the tech trade, that's going to weigh on those stocks as well, even if they have independently pretty strong fundamentals. Any rotation out of tech is going to weigh on those two stocks, and they're the two biggest market cap stocks in the entire discretionary sector. They command roughly 40%, last I checked, of the market cap of the sector alone. Right. So you would have to see some internal rotation inside discretionary as a byproduct of tech. Outside of those names, if you can get some improvement in consumer spending, you can see the rest of discretionary perform a little bit better. Now, I think that's a question mark as well. Remember, the Fed's been easing policy, really started back in 2024, took a pause in early 2025, picked it back up in the latter part of this year, but that has not helped the consumer case much. The consumer's just sort of been in a sideways trajectory in terms of spending. And that's because the consumer doesn't necessarily want to borrow more in this landscape. They need lower prices. They need material price deceleration. And while the Fed is saying slightly lower inflation is likely to come in 2026, it's still 2.5% inflation. And prices are still elevated for the consumer. So we would need to see a material deceleration in inflation, maybe even a material change in the dynamics of the housing market to make housing more affordable. An increase in supply could go a long way there to really light a fire under the consumer. I think you just want to be more cautious with respect to that sector. And frankly, this is different than normal. Usually when the Fed is reducing interest rates, the first sector that everyone points to as a likely beneficiary is consumer discretionary. In this environment, I don't think that's the necessarily first mover because of these unique dynamics of 2025, 2026.
So you brought up real estate and housing. So now with what I would think is going to be an aggressive rate cycle throughout at least the first half of the year of next year, is real estate an area? I have experts like yourself, Gina, that come on this show, and they're really negative on this sector. What do you think?
Yeah, I think housing, residential real estate right now is really tough. A few more decreases in interest rates on the short end of the curve are not necessarily going to reduce the cost of an average mortgage, right? The
Hmm.
long end of the curve has been pretty sticky, frankly, and it's not falling as much as the short end of the curve is. As I mentioned, that yield curve, a slope, is actually a reason to get excited about financials. But it's not necessarily a reason to get excited about residential housing, because what you have in the housing market is this unique dynamic of just persistently low supply with relatively strong demand. We don't have a problem of demand. We have a problem that there's just not enough supply, and that mismatch is creating very elevated prices and unaffordable homes. So you can get somewhere if you can get that mortgage rate lower. It's not really lowering as much as we would like to see. And at the same
Right.
time, we're not seeing this evolution of, major supply coming to the market to ease the problems in prices. That's the residential side. The commercial side is a little bit different. We are struggling with excess supply in certain segments of commercial, but we've just been through one of the most extreme accelerations in investment spending that we've ever seen in this economy. So there are portions of commercial real estate linked to sort of secular trends in tech, secular trends in industrialization, secular trends in healthcare that aren't necessarily as negative as the broader sort of real estate cycle might be perceived as because of residential. So I think it's really a tale of pick your industry within the real estate segment. Probably diversify your portfolio, think through industry allocations a little bit more carefully. And residential is unfortunately the struggling, one of the bigger struggling components.
I want to get your thoughts. I know you're the market strategist at HB Wealth, but I want to get your thoughts on commodities, particularly
Sure.
with gold and silver. We've seen just quite a run up, very bullish trade for this year, and there are some experts that believe that silver can really hit the $85 mark next year. What are your thoughts, though, as far as when it comes to the tangible assets? Should
Yeah.
investors continue to migrate a portion of their portfolios this way?
Look, long term, these are incredible diversifiers in a broad portfolio. So even in an environment in which prices don't accelerate at a magnificent pace as they have in 2025, they still provide a substantial benefit to your portfolio, just in terms of a diversifier. They're one of the very few asset classes that can diversify, right? We're in a world in which correlations seem to be moving closer and closer together between other asset classes. I noted Bitcoin, for example, and the NASDAQ. Those are very close correlations, particularly in comparison to the pre-pandemic time period. So I think we want to be really careful about what is a diversifying asset. And what we know is throughout history, the metals have proven to be diversifying assets. So that is the first case of sort of line of defense for if you're going to add commodities into the portfolio, think about the diversification benefit. Now, in terms of the price appreciation, it's hard to deny that the trends are very strong behind
Hmm.
gold and silver. The justification for those trends, though, I hear a lot of different reasons. And so I would say, can they continue to move higher? It probably will depend on a number of factors. The first to consider is what is the Fed doing and what is the federal budget doing? Because I do think that gold in particular has become a store of value for the average investor who's thinking about, man, the US federal deficit is getting out of control. We're just going to continue to borrow into perpetuity. The
Yeah.
dollar keeps plummeting as a result of that. And that's allowed for this flight into gold. The emerging markets also diversifying their central bank asset base into gold and away from fiat currency. So as long as those trends are continuing, gold probably continues to do a little bit better. Silver is a different asset, not necessarily viewed as a store of value, a play on currency, but instead viewed on growth conditions and as an inflation hedge. So
Hmm.
silver might depend a little bit more on what happens with growth, what happens with inflation, the true supply and demand dynamics that are emerging with respect to growth going into 2026. Broadly a diversifying asset class, so that's something to keep in mind, but price trends subject to movements in economic conditions.
Right. Okay. So then going into next week, those economic conditions are going to be front and center.
Yeah,
Everybody thought this week with the Fed meeting, that seems to be the appetizer because next week
yeah.
we're probably going to have intense volatility in the markets with the data that's coming out, the tsunami of data. I mean, will markets overreact, do you believe? Or, I mean, it's a little bit lighter volume now
Yeah.
because of the holiday season, but
Yeah.
how does that actually play out with the next Fed meeting the end of January?
Yeah, I think it's a great question. And this is, as you mentioned, this is the season in which you do see volatility usually become somewhat more elevated, and certainly the market's more sensitive to economic data. The reason for that is because we're not in an earnings season. I think that this is really
Hmm.
characteristic of every intra earnings period where the market becomes much more sensitive to what's happening with economic data, much more sensitive to what's happening with policy news, whether it be monetary or fiscal policy, even trade policy headlines still have the potential to whipsaw markets a little bit. So you do need to be prepared anytime you're not in the middle of an earnings season for the economic and policy data to become paramount in the market's mind. I would say that we are somewhat sensitive to the economic data right now because of the Fed, where the Fed has stated, look, well, they haven't stated overtly, but it's become basically understood that the Fed may squeeze in one more rate ease in early
Right.
2026, but then it's really up for grabs as to what they do after that. So that lack of visibility on where we're going into the broader 2026 is going to keep the market on its toes, I suspect, for the near term, probably into from December into January as well. The other thing to consider is once we get through January, the seasonality for the equity market changes. I think we're all sort of conditioned now to realize February to April is usually a pretty tricky spot for
Hmm.
stocks. We tend to become more sensitive not only to economic data, but to specifically movements in the bond market during that period because of treasury refunding cycles and the like. So it's something to just keep in mind. And let's not forget, we do have a lot of volatility potentially emerging with respect to the federal budget and maybe even another shutdown coming in early 2026 if we can't solidify the outlook for spending there.
Yeah, so much to look forward to.
Yeah,
And that is a very smart comment, actually. We are not in earnings season right now, and
right.
that explains a lot. So final question for you, Gina. Okay, it's 2026 coming up. I have to get your outlook. What do you think about the S&P 500? Will we see higher highs throughout the year?
Yeah, I think it's going to be a mixed year, frankly. The interesting thing about the outlook right now is we're coming off of a point where the market has become sort of severely overbought from at least one indicator that I think is pretty reliable, and that's the 3-year movement in the S&P 500. If you take a look at the 3-year rolling average in S&P 500 price, it's gotten to a point that is more than a standard deviation and a half above long-term average. When it gets to that level and even closer to 2 standard deviations above long-term average, which is where it was in October, you usually see the market at least take a slowdown. So we
Hmm.
are vulnerable to a slower pace of gains emerging in 2026. This fits nicely with an idea that maybe we're in a period of time in which we're ceding leadership from tech to other segments, which creates a little bit of churn in the market. It's not a bad thing necessarily for market performance to slow down a little bit. As a matter of fact, I'd say if we get a fourth consecutive year of double digit gains, it's a bigger risk than a fourth year of gains that is much slower than the gains that we've had for the
Hmm.
last three or so. So I think a healthy consolidation period is likely going into next year, maybe slower than average, slower gains than what we've become accustomed to in the last few years. But nonetheless, at least from a price performance perspective, it looks like the uptrend is intact, subject to any sort of shock coming from externally. The idea that the Fed is decreasing interest rates and growth is likely to slightly reaccelerate into next year should support a pretty healthy backdrop for equity markets.
Well, I love that. That sounds like a great Christmas present for everyone. So I know Wall Street would cheer the news on that one. Gina, I want to thank you for joining me. I know you're very busy. You had the big power move to HB Wealth, and I know things are going great for you. And I do wish you and yours a very Merry Christmas. Can't wait to have you back next year.
Okay, thank you. And the same to you. And we'll see you in the new year.
Sounds good, Gina. So on behalf of Gina Martin Adams, I am Todd Schoenberger. Thank you once again for joining us on the Money Path. Catch us next week. We have a lot going on next week with the economic data, as we were just talking about. Can't wait to see you then. Take care.
Access real-time data and intelligent analytics exactly when you need them. Get the right data at the right time. Learn more at quotemedia.com.